What's up, YouTube? In this video, we're going to be covering what the backdoor Roth IRA strategy is. I get a lot of questions on this from clients, students, and a ton of questions on it, as well as on my social media. So today we're going to break down what the backdoor Roth is, when it makes sense, and step-by-step how it works in plain English if you are a higher income earner and you're not really sure if this applies to you and you want to make sure you're doing about it the right way. So quick intro, my name is Jose Hernandez. I run a financial education company that serves first-generation wealth builders, people like you and me, people the first person in their family to start thinking seriously about investing. And my goal here is to help you reach your goal of financial freedom or building generational wealth for your family. And I started my career in the financial industry as a wealth management advisor. That's where I got my Series 7 and 66 licenses, worked with wealthy individuals, and that's where I learned everything that I've been sharing on the internet with people like you every single day over the past several years now. So without further ado, let's get into the video. Like I said, we're gonna be talking about what the backdoor Roth conversion or strategy is in some detail. So this video is gonna cover what the backdoor Roth is in a step-by-step framework. We're gonna talk about when the backdoor Roth strategy applies. So like, when does this thing even apply to me? When should I start thinking about this? We're gonna talk about how the backdoor Roth actually works in 5 simple steps. And we're going to quickly cover some mistakes to avoid. I'm thinking about making a separate video on the main mistakes to avoid, or the biggest mistake to avoid, that is, with the backdoor Roth, which is, of course, that pro rata rule, which we'll talk about very briefly in today's video, but let's get into it. So section 1 is, what is the backdoor Roth? What is the backdoor Roth conversion? The way I explain it to clients, students, and everyone else is it's basically a Roth IRA with extra steps. So in this visual, you'll see a chart. This is a little bit dated because it's showing $5,500. It's now $7,000 that you contribute, but in any case, this is how it works. Essentially, you're funding a traditional IRA with after-tax money, and then you're converting that over to your Roth IRA and investing that money. And in 1 second, we're going to look at the steps in much more detail, so hang around for that. But that's really what the backdoor Roth is, in a nutshell, is you're using that extra step of funding a traditional IRA, in this case with after-tax dollars, which we'll talk about here in 1 second, and then you're converting that money over to the Roth IRA. So this is really a workaround for you to be able to still put money into your Roth IRA, even if your income is over the Roth IRA income limits, which again, we'll talk about here in 1 second. So in a nutshell, what the backdoor Roth is the Roth IRA with an extra step of you using that traditional IRA as a workaround or as a backdoor to be able to get money into the Roth IRA, even though you're not able to put money into the Roth IRA the regular way. So in simplest terms, again, it's funding a Roth IRA, but with extra steps. So section 2, let's talk a little bit more about when the backdoor Roth actually applies. So like, when should I actually even be thinking about this? When does this apply to me? When should I start thinking about using this strategy, if at all? So what we need to understand is your ability to fund or put money into a Roth IRA the regular way is going to depend on 2 things. The first thing is your income, or to be more specific, it's something called your modified adjusted gross income, MAGI for short. And for a lot of people, their modified adjusted gross income is going to be pretty close to their adjusted gross income, or AGI. And that's something that you can find on the form 1040 that you get when you file your tax return every year. And if your income situation you feel like is going to be pretty similar, you can use that as a reference. As always, you consult with a tax professional or tax advisor when necessary. But the first variable, the first thing that determines whether we're able to put money into a Roth IRA the regular way at all is, again, our modified adjusted gross income, or MAGI for short. And then secondly, what determines your ability to put money into a Roth IRA is your filing status. In other words, how you file your tax return. So you can file single, you can file married filing jointly, you can file married filing separate. And this little table that we're going to take a look at here in 1 second kind of outlines what these income limits are depending on your filing status. So this is for the tax year for 2024. And as you can see, if you're single and your modified adjusted gross income is under $146,000, you can contribute the full $7,000 to the Roth IRA the regular way. You don't have to worry about doing the backdoor Roth IRA. And if you're married filing jointly and your MAGI is under $230,000, you'll see that you can still put the full $7,000 into the Roth IRA without having to worry about the backdoor Roth. So those are the lower thresholds: $146,000 if you're single, and $230,000 if you're married filing jointly. So where it gets a little bit tricky is when you're in this middle range, where you can only do a partial contribution into the Roth IRA, meaning you can't put the full $7,000 in, but you also don't necessarily have to put in 0 either. And this is kind of a little bit of a weird range to be in. And you could potentially use the backdoor Roth here if you wanted to keep it a little bit more simple. But once your modified adjusted gross income goes over $146,000 if you're single, but it's not over $161,000, that's when you can only put a reduced amount. And there's a calculation that you can look up in order to do that. But the main thing is understanding it's a limited amount. You can't put that full 7K or 8K if you're age 50 plus. And then for married filing jointly, if it's between $230,000 and $240,000, your modified adjusted gross income, that's where that partial contribution comes into play as well. So important numbers to understand there. Now let's talk about the upper limits. And this is the most important to understand, because if you're over these, you're basically blocked from being able to contribute to the Roth IRA the regular way. Because what happens is if you put money into the Roth IRA the regular way and your modified adjusted gross income is over these limits, basically what's going to happen is you're going to get penalized. And that kind of defeats the purpose of the Roth IRA in a sense. So those limits are, if you're single, once your modified adjusted gross income in 2024 goes over $161,000, you're basically blocked from being able to contribute to the Roth IRA. And that's where the backdoor Roth really starts coming into play. And if you're married filing jointly, that number is $240,000. So again, the upper limits to keep in mind here are $161,000 if you're married, $161,000 if you're single, and $240,000 if you're married filing jointly. So let's move on to section number 3. Now that we understand what the backdoor Roth is, we understand when it applies, specifically when it comes to income limits and your filing status. Let's say that you're in a situation where like, okay, I know for sure my income's going to be over that, whether I'm single or married filing jointly. So how does this backdoor Roth thing work step by step? So let's break that down. Step number 1 is you're going to do what's called an after-tax or non-deductible traditional IRA contribution. So in plain English, if you don't already have a traditional IRA, you're going to open up a traditional IRA and you're going to fund it with the maximum that you can contribute in 2024, that being $7,000 if you're under 50 or $8,000 if you're age 50 plus. So you open up a traditional IRA if you don't already have it, and you're going to fund it with that amount. But the key here is it has to be considered an after-tax or non-deductible traditional IRA contribution. So this money that we're putting into the traditional IRA has already been taxed. This is after-tax money. Cannot stress that enough. Some platforms will ask you when you put the money in, hey, is this deductible or non-deductible? Some platforms, like I've seen with some of my clients and students, don't ask you that. In either case, it's going to be your responsibility to let the IRS know, hey, this is after-tax money. And that's what the Form 8606 is for, which we'll talk about here in 1 second. But in any case, step 1 is we're going to max out that traditional IRA with after-tax money. Step number 2 is, and before we talk about step number 2, it's really important. We want to keep that amount that we put into the traditional IRA as cash. We don't want to invest that money just yet. We want to keep that money just as cash without any gains tied to it, because for step number 2, what we're going to do is we're going to do what's called a Roth conversion. And the Roth conversion is you taking the money in the traditional IRA and basically just transferring it over to the Roth IRA. You can do this online with a lot of platforms. Some platforms require you to fill out paperwork. But in any case, what you're going to do is you're going to tell your brokerage platform, I have this money in my traditional IRA. I want to move this over to the Roth IRA. And this is why the backdoor Roth works currently, is because there's no income restrictions on your ability to transfer money from a traditional IRA over to a Roth IRA. There was some legislation that was being passed around trying to block this, but as of the recording of this video today, this is still legal. And that's my dog Penny's walking around if you hear some footsteps. So step number 2 is we're going to process the Roth conversion. As a pro tip, it is generally best if you give it at least a couple of days to kind of just give it some time for that cash to sit in the traditional IRA and then convert it over to the Roth IRA. That way it doesn't look like just one transaction basically, and the IRS can't say, hey, you actually put $14,000 into your IRAs for the year, which of course you're not allowed to do. So as a best practice, at least giving it a couple of days is advisable. And then step number 3, once the cash is inside the Roth IRA, once we process that Roth conversion, then we're free and clear to invest the cash inside the Roth IRA. And that should be pretty straightforward. If you're already investing, you can just follow the similar type of strategy that you're already following inside that Roth IRA. You can keep it simple with index funds or ETFs, but in any case, we want to make sure that money actually gets invested. Step number 4 is we're going to want to avoid something called the pro rata rule. And I'm probably going to make a separate video on this entirely because this is the biggest thing that I see most people screw up when it comes to the backdoor Roth conversion. The simplest way for me to try to explain this is the pro rata rule basically forces you to pay taxes again on the Roth conversion. But if we do this backdoor Roth conversion correctly, we're only paying taxes once. And that's in step 1 when we fund the account with after-tax dollars. That money's already been taxed. And the purpose of keeping that money as cash is there really shouldn't be any gains tied to the money that you convert over to the Roth IRA because it's just cash. It hasn't gone up in value, and there should not be another taxable event. And when you fall victim to the pro rata rule, the IRS says, hey, actually, you know what? We're going to treat part of that after-tax money that you converted over as pre-tax, and you're going to have to pay ordinary income tax on a portion of that. And the way that you avoid this is you want to make sure you don't have any pre-tax dollars in any traditional SEP or simple IRA by December 31st of the tax year that you do that Roth conversion. So what a lot of higher income earners will do, some of my clients and students as well, is if they have access to something like a 401k that allows for the rollover of pre-tax IRA money into it, that is a way to circumvent the pro rata rule as long as you do this before 12/31, which is again the date that the IRS looks at for the sake of the pro rata rule. I know this is kind of confusing. The main takeaway here is we want to avoid having any pre-tax money in any type of traditional, simple, or SEP IRA by the end of the tax year that we're doing this Roth conversion so we aren't taxed again. Again, I might just do an entirely separate video on that, but that is the biggest thing I see a lot of people screw up on this backdoor Roth conversion. And then step number 5 is we're going to file something called Form 8606 come tax season. This is a really straightforward document. It's like 2 or 3 page PDF. I believe you can get it directly from the IRS website, but here's where you're going to report step 1, the after-tax contribution. You're going to report how much was converted, and if you did this correctly, there shouldn't be any gains tied to the amount. So it should be identical, if not as close to identical as possible as the amount that you contributed and the amount that you converted. And then this is also where you're going to keep track of the tax year that you're doing each conversion, because the 5-year rule in the future, if you decide to withdraw some of the amounts you converted, you want to make sure that the 5-year rule has been satisfied so you don't have to worry about getting taxed again on money that you've already been taxed on, essentially. So the backdoor Roth in 5 simple steps. Step 1, that after-tax non-deductible contribution to the traditional IRA. We're going to keep that money as cash. And then step 2, we're going to do a Roth conversion, convert that money over to the Roth IRA, transfer it directly, essentially. Step number 3, once the money settles inside the Roth IRA, we're then going to invest it. Step number 4, avoid that pro rata rule by avoid having any pre-tax money in any traditional IRA by the end of the tax year. And then step number 5, file Form 8606 come tax season. Your tax advisor, tax professional should have some understanding of what this form is. It just reports exactly what you did. And then from here, it's just rinse and repeat. So a lot of clients and students, what they'll do is come January of the next tax year, they'll just rinse and repeat. I know it feels a little bit intimidating at first, but it's really straightforward once you do it the first time. So moving on to section number 4 of the video, we're going to talk about the main mistakes to avoid if you are thinking about going down this route. Number 1 is, of course, you're not marking that traditional IRA contribution as after tax. If you treat it as a pre-tax contribution, that money is going to be taxable to you when you convert over. We want to pay the taxes up front, not on the conversion, right? And that is either because you didn't mark it as a non-deductible or after-tax contribution on the investing platform that you use, and or you didn't file that Form 8606 letting the IRS know, hey, this is after-tax non-deductible money in the traditional IRA. Number 2 is not keeping the money as cash inside the traditional IRA. Remember, we don't want to invest that cash just yet. We just want to keep it as cash that we avoid having any gains on that money before we transfer it over to the Roth IRA. So for example, if you put the $7,000 in and you invested it, and then that goes up to, let's say, I don't know, $7,100, and then you convert over, that $100 in growth, part of that could be considered taxable as ordinary income. And again, if we're doing this correctly, if we're doing this backdoor Roth conversion correctly, we're only paying taxes once, and that's on the front end when we earn the money that we put into the traditional IRA. So not keeping the money as cash can be a mistake. Of course, mistake number 3 is not investing the cash inside the Roth IRA. It's not enough to just transfer the cash into the Roth IRA, as hopefully you know by now. You want to make sure that money actually gets invested. And at that point, it should be pretty straightforward. If you already know what you're doing, just reinvesting the cash into your existing strategy in the Roth IRA. Number 4, which I already mentioned, is the biggest one, and I'm probably going to make another video on this in particular, is falling victim to that pro rata rule, which is, again, basically you having to pay taxes again on a portion of that money that you already paid taxes on, because the IRS is considering part of the after-tax money as pre-tax. And whenever you convert pre-tax money from a traditional IRA over to a Roth IRA, that amount can be taxable to you as ordinary income. And if you have a lot of money in separate traditional, simple, or SEP IRAs, a lot of that money that you convert over can be considered taxable as ordinary income. So how do we circumvent this? Of course, we keep any pre-tax money that we have in retirement accounts in things like qualified plans like 401ks, which the IRS does not look at for the sake of the pro rata rule. And of course, not filing Form 8606 come tax time. It's always important to keep accurate records as an investor, as an individual, as a family, as a household. And that Form 8606 is very basic, but it keeps up with really important information from a tax perspective. That way you're keeping everything clean, and you can avoid, more importantly, you can avoid having to pay taxes again in the future when you've already met the requirements to not be taxed again. So that's the backdoor Roth in a nutshell. If you're watching this and you feel like I have no clue what I'm doing with my investing, or maybe you've been investing for years now, you're not really sure if you're on track, and you want to make sure that you are doing things correctly, you are investing enough, you are following appropriate strategy, you're doing all the things correctly to reach your goal of that financial freedom or building generational wealth for your children, or any combination of those things, and you need some help, I'm putting a link in the description of this video of how you can schedule a time to meet with me one-on-one. Happy to have more of a conversation to see how I can help. Again, the description, the link for that is going to be in the description. So that's all for me. Hope you found this helpful. Subscribe to the channel, leave a comment, and I'll see you in the next one. Thanks.